Understanding what grandfathering clause is could be a game changer for your financial future. If you are holding on to the stocks or equity mutual funds for years, a significant portion of your gains could be completely tax-free when you decide to sell. Why does this matter now more than ever? With the recent increase in the LTGC or long-term capital gain tax rate to 12.5%, the grandfathering clause has become even more valuable. Hi everyone! Did you know that your long-term stock and mutual fund investments might be hiding a treasure trove of tax-free profits? Yes, that's right. You could be eligible to pay absolutely no capital gain tax on a significant portion of your gains when you sell. Sounds incredible, isn't it? Well, in today's video, we are going to uncover a little known gem in Indian taxation, that is grandfathering clause. Stay tuned till the end because this information could potentially save you lakhs of rupees in taxes. If you're new to this channel, let me introduce myself. I'm Keerthi. I live in Dubai, where I run The Consultancy, a firm which is specialized in NRI services. I've completed my CS from India and also CMA strategic level from UK. I'm also a SEBI registered overseas MFT. Every week, I bring you and explain a video related to various NRI issues in this channel. If you're looking for any insights on finance or FEMA or investment tax related topics, please subscribe this channel. Now let's go back to the topic. For any long-term investor, knowing what exactly is grandfathering clause is very important because at some point where your investment or portfolio size has grown, or you might be considering reshuffling or selling also, this provision becomes incredibly valuable. Or maybe you have been holding on to the stocks for years and you're waiting for the right time to sell. In either of these cases, understanding what grandfathering clause is could be a game changer for your financial future. So let's dive right into what grandfathering clause is all about. The grandfathering clause is a special provision introduced in the Finance Bill of 2018. It is designed to protect long-term investors from sudden changes in the taxation or tax laws. Here is a key thing that you need to know. Any capital gains that you have made on your equity investments up until January 31st, 2018, they are completely tax-free. Now you might be thinking, wait a minute, I thought that the long-term capital gains were always tax-free on the stocks and equity mutual funds. And you would be right, but only up until 2018. That was indeed the case. But things have changed with 2018 budget. The Government of India had reintroduced LTGC or long-term capital gain tax on the equity investment starting from April 1st, 2018. What is the rate of taxation? 10%. So 10% tax was made applicable to the long-term capital gains exceeding 1 lakh rupees per financial year. Let me stress upon this. This is exceeding over and above 1 lakh rupees per financial year. But here is where it gets really interesting. They also introduced a grandfathering clause to cushion the blow for the existing investors. So now you might be thinking, how does this grandfathering clause help existing mutual fund or stock investors? The grandfathering clause essentially creates a cutoff date, January 31st, 2018. Any appreciation in your investment's value up to this date or capital gain that you've made is considered tax-free till this date. Only the gain made after this date are subject to LTGC or long-term capital gain tax. This is huge for long-term investors. If you are holding on to the stocks or equity mutual funds for years, a significant portion of your gains could be completely tax-free when you decide to sell. Of course, this matters because the investors who must have made the decision to invest in Indian market much before this announcement or changes of 2018 budget, they shouldn't be made to suffer. So these grandfathered people have right to avail the concession. That's it. Let me explain in a simple way. I will break it down with an example. Imagine you had bought 1000 shares of a company XYZ on January 1st, 2015 and the cost of acquisition was 200 rupees per share. Now the total investment was around 200,000 or 2 lakhs rupees. Now let's say you have decided to sell the shares on May 19, 2018 for 400 rupees each, which gives you total of 400,000 or 4 lakhs rupees. The first glance, you might be thinking you're going to pay LTCG or long-term capital gain tax on the entire profit of 1 lakh. This is because up to 1 lakh it is tax-free. So for the next 1 lakh there will be LTCG tax applicable, right? This is exactly where the grandfathering clause comes into play. See, there is a simple formula. Let me try to put it in a simple way. I'll try my level best so that you will understand. We need to consider the fair market value or FMV of your stocks or shares on January 31st, 2018. Let's say that was around 250 rupees per share. Then this is how the calculation works. First, you have to consider original purchase value, which was 200,000 or 2 lakhs rupees. Second one, you have to take FMV or fair market value as on the date of January 31st, 2018. So which is 250,000 or 2,50,000 rupees. And third is sale value, which is 4 lakhs or 400,000 rupees. So what is the capital gain here? First, what we need is cost of acquisition, right? The cost of acquisition is nothing but higher of original cost of acquisition or lower of FMV, fair market value, or sale value. 200,000 or 2 lakh is the cost of acquisition. The lower of sale value or FMV is 250,000 because we have sold it for 400,000, right? So for tax purpose, your cost of acquisition is considered as higher of the actual sale price, which is 200,000, or FMV, that is 250,000. So which is higher? In this case, we are going to take 250,000. So the taxable long-term capital gain is the sale value 400,000 minus cost of acquisition, which is 250,000, which gives us around 150,000. Now we have already understood that the taxation is applicable over and above 1 lakh rupees. So only 50,000 of your profit is going to be subject to LTCG tax. So the other part is completely tax-free thanks to the grandfathering clause. Now let's talk about the latest update on LTCG tax rate because it matters a lot in this context. While the original LTCG tax rate was set at 10% in 2018, there has been a recent change. As per 2024 budget, the LTCG tax rate had been increased from 10 to 12.5%. So there had been an increase of 2.5%. So how can you make most of the grandfathering clause? Here are some key strategies. Don't assume all your gains are going to be taxable. Many investors make this mistake and they end up overpaying tax. Second is meticulous record keeping of your purchase dates as well as the price. This will be crucial for calculating your tax liability accurately. Third one is use the FMV or fair market value to your advantage. As we have seen in the example, using the FMV on January 31st, 2018, we could significantly reduce the taxable gain if the value of the investment had increased by that date. Fourth one is consult professionals for complex calculations. If you have made multiple purchases over the time, or if you are dealing with mutual funds that have undergone mergers and splits, then the calculations can be really tricky. Last, fifth point is leverage technology. There are specialized software tools that can calculate the exact tax implication for your investments. Why does this matter now more than ever? With the recent increase in the LTCG or long-term capital gain tax rate to 12.5%, the grandfathering clause has become even more valuable. For long-term investors with substantial holdings, we are talking about potentially saving probably lakhs of rupees in taxes. Moreover, if you are holding on to the investments for many years and you don't know which is the right time to sell and you're probably waiting for that right time, then this clause could be a game changer in your decision-making process. It might make selling more attractive now, especially if a large portion of your gain is falling under the tax-free umbrella. Let us look at the bigger picture of smart tax planning. The grandfathering clause is just one example of how understanding tax laws can significantly impact your investment returns also. It's not about evading taxes, but it is about using the tax laws as they were intended to optimize your financial return. or outcomes. So it's all about tax planning, not at all tax evasion. This is why it's very crucial to stay informed about the changes in tax laws and to work with a financial professional who can help you navigate all these complexities. At The Consultancy, we are passionate about empowering investors with the knowledge and tools to make most of your hard-earned money. Remember, knowledge is power when it comes to investing. The grandfathering clause is just one of the many pieces of knowledge or tools which is available to smart investors. By staying informed and proactive, you can ensure that you are not just growing your investment corpus or wealth, but also keeping most of it in your pocket. That's it for today. Thanks for tuning into this deep dive on the grandfathering clause. If you have found this information helpful, please like, share, and subscribe to our channel for more such insights on the personal finance as well as on smart investing. If you have any questions, drop them in the comment section. We are always here to help. Until next time, this is Keerthi from The Consultancy, wishing you a very happy, tax-efficient investing. Bye-bye. See you next week.